Good morning and welcome to the November edition of The Balanced Perspective. As usual, I'm your host, David Levinson of Net Group Investments, and we're joined on the line by Iain Power, the CIO of Truffle Asset Management. Iain, as always, thanks so much for joining us today.
Morning, Dave, and good morning, everyone who is signing on to the call.
So the title for today's session is Deglobalisation and Nationalism, and is this a threat to global equities? The past decade, we've seen a resurgence in far-right politics, anchoring on nationalistic sentiment while protecting domestic interests, culture, and even jobs. Leading into this, the world probably experienced unprecedented globalization, allowing certain countries and, of course, sectors in those countries to flourish. I'm sure, like me, you're absolutely fascinated by global politics and wake up each morning and look at your phones and read the global headlines around this. So I'm particularly keen to hear from Iain what weight he and the team give political developments in their investment decision making. So Iain, I'd like to bring you in here for our first question. So I came across a recent Financial Times opinion piece basically asserting the idea that deglobalization will come with many negative consequences. So I'm curious to see how you see this playing out, and should investors recalibrate their expectations in light of probably more fractured trade and less cooperation from global parties?
Oh, David, that's right. I think the world has benefited from many decades of globalization and the benefits that I think come from that. And I think sometimes it's important to take a step back and just look at why companies do globalize and what are the reasons for this. And effectively it goes back to economic theory, which is that countries will try and exploit their competitive advantages in terms of what they have to offer versus competitor geography. So for example, manufacturing may move to countries or geographies where they've got excess labor and where labor is cheap, and that obviously then allows investment in those countries to exploit that particular cheap competitive advantage, and that flows through to consumers in the face of cheaper products and where you get deeper specialization, and you get longer runs and longer manufacturing processes, which ultimately benefits consumers not just in the price that you're paying for that good because it's now being made or manufactured in the cheapest area of the global supply chain, but you also get the benefit of specialization. So because you are specializing and able to then manufacture these long lines and manufacture many millions of these widgets, you are able to do it better. So consumers get the benefit of not only cheaper products but better products, and I think that's important to remember in the context of the debate. So I think you're right. We're seeing a reversal of these trends which have been in place for many decades, and I think really driven by the geopolitical tensions, which are frankly only going to accelerate and move higher. And the obvious one we'll point towards is the Russian-Ukrainian war, and the extent to which that is impacting supply chains through higher commodity prices. But then there's the bigger one of China, which is a much bigger economy than Russia, and there's a Cold War which is now starting to, settle down again, and not just, typically like we saw in the past between the West and the USSR, but between the West and Russia in the guise of also technology war. And I think this is going to have big implications for consumers and global inflation, because it ultimately means that countries and companies don't want to be hostage to supply chains in far-flung areas of the world where suddenly you have an inability of getting those portions of your supply chain or product back to your consumer, which then puts you in a difficult position to compete when you can't get product. So I think manufacturing processes are starting to come home, and when they come home at the expense of cost. So it's not always cheaper to bring them home, but they're now, higher motives in terms of what is driving policy in terms of geopolitics. And it, the long and short of it means that consumers will pay more and probably end up with inferior quality products.
Thanks, Ian. Maybe we can address that inflationary consequence if we have time towards the back end of the session. You mentioned economic textbooks. I remember back in 2000, I think our textbooks showed that manufacturing in South Africa was roughly 20% of GDP. I believe it's maybe not even 10% today. So that's probably a consequence of outsourcing a lot of the manufacturing, particularly out to the Far East. But at the same time, our manufacturing may have been hurt, but our resource sector has benefited from this globalization. So as the world decouples from globalization and probably brings a lot of things onshoring, do you see a new set of winners and losers in this new paradigm?
So I think the first thing that investors need to, I guess, one of the big things investors need to be cognizant of is that corporate profitability is going to be one of the areas that is going to take pain and pressure from the repositioning of supply chains and supply lines. So, in a world where we've all been operating on a just-in-time basis, companies probably going to be carrying more inventory, and secondly, it will cost them more to assemble or manufacture in country or in other countries which are perhaps less risky from a geopolitical point of view versus where they were. So I think the first takeaways is the earnings and the margins of lots of these companies are probably going to come under pressure on a structural basis. And then secondly, you're going to have higher prices coming through to the consumer. So I think, when we stand back and we look at the landscape, consumer discretionary income looks like the most likely place that is going to take pain, where consumers have to reallocate away from discretionary spending to more of the grudge type purchases, things like energy, food, etc., and then ultimately, pay away more in inflation because of some of these big global changes that are starting to take place.
Mm. Yeah, I know during the Trump administration, in the beginning, I mentioned far-right politics. They were looking to bring a lot of that manufacturing back home in the name of job creation. Ironically, that leads to inflation, and the Republicans are pushing for lower rates from the central bank there. So maybe it's a little bit of their own making. And maybe we experience a little bit something similar here in South Africa as well, as the supply chains get a little bit throttled. And I like the fact you brought up some of those political risks. So companies looking abroad, are their value chains and logistics exposed to some of that political risk in light of certain uncertainties? And you mentioned Russia, a lot of what we're seeing out of China as well recently. But I mean, it all sounds rather negative. Are there any silver linings to this trend that we're seeing?
So, I think the silver lining is also, I guess, avoiding some of the negatives. As you know, Truffle, one of the big value adds we think is to avoid bombs and avoid permanent capital diminution. So I think, to the extent that one is wary of where the pitfalls are, I think that is a positive. But then secondly, to the extent if you are, let's call it the next cheapest destination for manufacturing. So, for example, manufacturing right now is moving out of China and moving into Indonesia or friendly parts of Indonesia. That then would be a positive for their economy. So they would be, let's say, the next cheapest destination to manufacture, from a geopolitical perspective, perhaps not as antagonistic as China, which means that economy, then gets a boost to the extent of all of that investment. But I think, the long and short of it is also not as, I guess, simple as that, because some companies in their manufacturing processes also, because of where they're situated in the world, don't necessarily are not exposed to production processes in the East or in Europe, for example, to the extent that they're now in a difficult position. And let me give you a quick example. So European aluminium smelters at the moment today, it's probably cost you about $6,000 to smelt a ton of aluminium in Europe, and you're selling it for sort of $2,500 a ton. So, if you are manufacturing or smelting aluminium in Europe, you're certainly not going to be doing that in the foreseeable future because of the size of losses, and that's just because of the energy costs that go in there. So these aluminium smelting businesses would be looking at their geographic footprint and saying, well, where else can they situate smelting capacity where you've got at least the competitive benefit of lower energy? And countries which are long energy are then likely to benefit from having access to lower cost energy as compared to perhaps Europe that has to buy in now very, very expensive energy. So there are winners and there are losers. And if you are one of those companies that, for example, you have access to geothermal power, and you've literally, these are historical costs, you get this massive benefit of then being able to pick up production from the higher cost producers, which are now being squeezed out. Now, I mean, maybe that's slightly different from deglobalization, but I think the conflict between Russia and Europe, talks to some of these geopolitical tensions and pressures, which we think continue to ramp up. And it means that countries then look to be self-sustaining. You mentioned right-wing nationalist type policies, and we think you probably see more of that. And all of this points towards, higher costs. But there are definitely some winners, and it'll be those guys that have those deeper moats. They have those accesses to the cheaper sources of commodities versus their peers. In other words, companies which are lower on their respective cost curves. That's where you got to be fishing, because they're going to be able to withstand the pressures of the repositioning of the global supply chains in a way in which they can protect margin and perhaps steal some of that market share. So it's not all doom and gloom.
Yeah, thanks, Iain. I know you've spoken about the inflationary impact of renewable energy in the past, and we don't have time to speak too much about energy today, but I know Europe have typically imported a lot of their sources of energy, and now policies are more about ring fencing this and maybe trying to negate that exposure to what's happening politically and globally, and politically at least, in the energy production. Energy security is probably the word I'm looking for there.
Yeah.
I'm also quite keen to hear your guys' thoughts on, or at least your thoughts and the team's thoughts. Very difficult to ignore the COP meetings taking place this week. You've spoken in the past about some of those climate impacts and the inflationary consequences there. Just for the last 2 minutes, maybe touch on some of your thinking there again.
Yeah, so I think maybe just a few sound bites and echoing what we've said before. We think climate change is going to be very inflationary in terms of certainly access to many commodities and the way in which businesses do business, whether it be crops, whether it be the extent of lack of rainfall or too much rain falling in the wrong areas. What this is doing is it means that traditional ability to grow and supply commodities, agricultural commodities, is under threat. And then secondly, from a transport and a power perspective, you're also seeing impacts in terms of the whole production system. So, for example, hydropower plants, which historically could be relied upon, today the frequency and where the rain is falling, lots of these hydro stations frankly, are not being able to be used because of the lack of rainfall. And one of the biggest ones in the news that perhaps some of the listeners might be aware of is the Three Gorges Dam in China. And if you just Google, you will see that, southern China is experiencing a terrible drought, and they are unable to use or at least access that hydro energy that they were from that dam. So climate change is going to have a big impact in terms of production costs, logistics costs, and once again talks to that pressure on discretionary income, which is coming down the track for consumers as they have to, still spend on those non-discretionary items to basically stay alive.
Thanks, Iain. I mean, not just China, as we move across the continent as well. India you're experiencing 50 degrees Celsius early this year. Massive flooding in Pakistan at the moment. I think as much as a third of the land there has experienced flooding, and the costs are in the sort of billions of dollars as well. And then even a famine on the Horn here in Africa as well, in East Africa. And many view Africa as a potential breadbasket for the world. And if we're experiencing this level of climate change, you can see this requires a degree of global cooperation, as does the climate change agenda obviously being discussed in Egypt this week. So as usual, Iain, we've run out of time, but thanks for your time this morning.
Thanks, David, and thanks to everyone for listening this morning.
So just to recap, I won't keep you too much longer. The globalization trend that we are seeing will mean higher corporate costs for the private sector. The effects of deglobalization will be inflationary, as manufacturing is often brought home. Indonesia, Iain gave as an example, where manufacturing is moving to safer countries, where political clarity is probably more apparent than the likes of China. climate change will be inflationary and ironically will require mass cross-border collaboration. So that's all from us today. As always, thanks for joining us. Take care, and we'll catch up with you next month. Goodbye.